Hello guys, and welcome back to another video. In this video we're going to continue our series on market structure masterclass. So in this video we're going to talk about the higher time frames protocol, and before you continue, please make sure to check out SMC Market Structure Essentials so you don't get lost. So we're going to start off with identifying higher time frame levels. Let's look at liquidity pools. Okay, so there's three higher time frame levels that you should be focusing on. There's order blocks, liquidity pools, and fair value gaps. So first of all, we're going to talk about liquidity pools. Now, when it comes to liquidity pools, a lot of traders make the mistake of falling victim to liquidity purges. Okay, so what a liquidity purge is, you have a high, a purge above that high, and then the market trades lower. Okay, so this would be considered the purge. Okay, the purge is just the raid on liquidity, sweeping the liquidity like we have here. Okay, this move right here would be purging the liquidity. The problem though is a lot of traders misinterpret liquidity purges as a break of market structure. So what that is there's a high, low, high. Okay, now the problem a lot of novice traders make is they see that high as a break in market structure. So MSB, BOS, whatever they call it, a break of market structure. Okay, so what they then do is they start having limit orders here in a discounted market compared to this low to this high. This would be considered discount. They have their buys set there, and they're expecting price to do something like this: trade into the discount and then create another high. But what instead happens is something like this. Price completely disrespects their level and just comes with this low. Okay, which makes this move right here the purge, and they fall victim to it. They fall victim to this very impulsive move here because they thought it was a high, and MSB. But in reality, it's just a purge. Okay, and the market will reverse in the other direction. So something a little like this. You have a high here and a high. Price closes cleanly above these highs, and people would consider that as a market structure break with a clean candle close. So they start looking for buys and an order block, but that order block doesn't hold and just completely reverses in their faces. Okay, so let's talk about the victims of the liquidity purge. Okay, and we need to understand the victims of the liquidity purge, because once we can put ourselves in their position and understand, okay, if they bought that breakout, or if they try to buy the dip, their stop would be right here. And as a market maker, you want to be thinking like one. Okay, you want to be thinking, okay, where are the victims' stop losses, and how can I target it? And this is the first step. It's understanding liquidity purges. So victim one is your typical retail trader that buys, uses retail patterns like bull flags or head and shoulder breaks or whatever. I don't really know anything about patterns. But what they do is they just buy the breakout. Okay? And when you're buying the breakout, you're buying the most expensive prices. Okay? So let me explain this. So if we have a trading range, something like this, and then this would be your range high, and this would be your range low, and then this would be equilibrium. In this range, above equilibrium is the premium prices, below equilibrium is discounted prices, okay? But once price starts breaching above into premium, and it doesn't stop, it goes for the high here, that's what we consider very extreme prices, okay? Because that's where retail traders start buying, okay, at a premium price because they're chasing it now, okay? So be aware of when this is happening, especially if the higher time frame says we have to go down, okay? In a bearish trend, you should see price trading above old highs as a potential resistance level, right? So if the order block here doesn't hold, if the gap here doesn't hold, then you see the liquidity pool above it to be the most extreme level in terms of resistance, okay? So just like how a fair value gap can be a resistance level, a order block can be a resistance level, the most extreme prices here can also be a resistance level. So we should also view it as one. So here, this can be considered as a resistance level when we trade above it, okay? And it's considered the most extreme resistance level. People that are more informed, however, they trade order blocks, they trade fair value gaps. Sometimes, if you don't check the higher time frame, and price is in a premium here, and you're looking for fair value gaps to buy or order blocks to buy, within this area, you're looking for order blocks to buy, fair value gaps to buy, they're not going to hold, okay? Because this is the most extreme premium. As soon as we break a high, it's the most extreme premium, and bullish levels don't blend well with premium conditions, okay? So that's victim one. They'll be buying here, and then sometimes they buy here. This might be you. They buy here, and then price just reverses on them, and then they don't want to accept they're wrong, so they start moving their stop losses down and down and down and down to this low here, and then they think, oh, it's never going to reach that point, so I'm just going to move it there. But in reality, they've fallen victim to the purge. So that's victim one, okay? If they're not willing to take a stop out after price reverses on them like this, and they drag their stop loss to another low, they're going to get punished for that as well. So if that's you, now you're aware to say, okay, if I get stopped out, then just take the stop out, okay? Move on. Victim two is the person that buys the retracement. So they understand, okay, I shouldn't chase price. Let's do it here. They understand that I shouldn't chase price when it creates that higher high. I should wait for it to pull back within the range into discount market and then buy for higher low. But we understand that if this high becomes the parent order flow, because this is a high time frame resistance level actually, opposing levels such as this order block or this fair value gap here or this low are going to be seeked. Okay, so remember the previous video I just made, where we had a daily level, a daily liquidity level, hits it, and then trades in the other direction. It's because this level acts as the parent order flow, and then anything against the parent order flow starts breaking. So this order block breaks, this order block breaks, this fair value gap breaks, and then that's your draw on liquidity. these lows here. So although buying retracements is what you want to do, it must align with parent order flow. So instead of buying this retracement here at this order block for a high low and expecting a high high, what you should have done is sold this retracement for a lower low. You see, this one plays out because it's trading with the parent order flow, which is a run on highs. That's a purge of liquidity, and then that's your short setup there. So now that we understand the two victims, okay, their stops would be the draw on liquidity, okay? So this move right here is a purge, okay? We have an old low here. People will be selling at a discount, FOMOing, they'll be selling. But to the interbank trader, we say that's extremely cheap because price is traded below an old low, okay? Now that would act as parent order flow, okay? Where are the people that sold this move going to place their stop loss? Well, you start looking to the left, here, or even here, okay? Or it could be someone who's more aware. They understand that I should sell a retracement instead of chasing on the breakout here. So what they do is they look for here range high, range low, and this is pre-market, so they sell. Oh, that's an order block right there, so they sell there. But like I said, if you're trading against the parent order flow, your level is just going to break, okay? So the person that sells there, order block and a fair value gap, that's a very high probability pattern, but if it's against the parent order flow, it's supposed to break. The person that sells that order block, however, where they're going to place their stop, they're going to place it here. So that's why we view this entire leg as the inducement liquidity. Okay, so the purge happens here. This induces shorts in the market. How does it induce shorts in the market? People selling on the breakout, 1. People selling on a lower high, 2. Where is their stop loss going to collectively pull? Right here. So that entire move just generated a ton of liquidity above this high, hence the name inducement. Okay, hopefully that makes sense. Same thing here. This is the liquidity purge here. How does this move induce liquidity? People buying at a breakout here, 1, or people buying at a dip, 2. So 1 and 2, where they're going to place their stop, where's the most logical area? Their stop's going to pull here, especially the people that thought this is a double bottom as well. So always look to the left, and you can see sometimes it's forming even more liquidity. Okay? And sometimes liquidity purges can happen on a very big scale. Okay? So here, breaks clean highs, where they're going to place their stops inside the range, or even here. So if you checked out Bloomberg at the time, Bloomberg, the very worldwide news channel, everyone and their mom was telling that's the low for the S&P market, and they might have bought the S&P 500 right there and they want to hold for 5-10 years because they see it as an investment. Okay, so they feel like their stop loss is clean here and it's nice. It's never going to see that area again, and they actually might buy some more at the breakout there because that's how a retail trader trades. Understand that although this might look like a big area of time, some people are really playing for the bigger picture. They're playing for 5-10 years ahead of the game and not just day trading. So what liquidity pools to focus on? Okay, we're talking about extreme prices here. And extreme prices are when price breaks out of a trading range. Okay? Here, that's the most extreme prices. And the first liquidity pools that we want to focus on are previous month highs and previous month's lows. And a little tip for you guys, when it comes to liquidity pools on the daily chart, you want to make sure that liquidity pools that you're using have space and time between them. So what do I mean? If you look at this purge right here, you want to make sure that this area right here, we have space and time, tells us that there's time for liquidity to accumulate above this high. Okay. Also, previous month's highs and previous month's lows offered a really big reaction afterwards. So you can see here, low of September, reaction happens afterwards. It's because these liquidity pools are higher time frame liquidity pools. Okay. High of November here, high of February. We also want to focus on previous week's highs and previous week's lows. So previous week's highs can also be used a very similar way. Okay. So previous week's highs and lows are support and resistance levels. Here, previous day's low, which we'll talk about next. But previous day's lows and highs, we're going to talk on an intraday basis. So when it comes to the higher time frames, please just focus on the month's highs, month's lows, week's highs, and week's lows. You can also use liquidity pools when focusing on internal range liquidity. Okay, so internal range liquidity is when price has a trading range like this, and we're seeking discount market, for instance. This is when price seeks internal range liquidity rather than external range liquidity. Okay, so what I mean by this is we have a trading range here. We can use liquidity pools inside of the trading range. Okay, so if this is low and high, if we have a swing low inside of that trading range, that would act as a liquidity pool. So price would seek that to trade higher. Now what you want to do with internal range liquidity pools is you want to blend them with something. Okay, so what I like to blend them with is 1, an order block, or 2, a fair value gap. So we can see here, if we did that very thing, we have a previous week's low, and we look to the left, where could price trade into also? Well, we have a down candle here. We'll use the mean threshold of that. So that's an order block plus internal range liquidity in form of previous week's low. Okay. Same thing here. We have this entire leg here. So this entire move down here. Inside of that range, we have clean highs. So that clean high can act as a liquidity pool inside a premium market. So this entire area is premium from this high to this low. We can use liquidity pools inside of that range as a resistance level here. Okay. Same thing here. We have this high to this low. Inside a premium, we have a swing high there. And like I just mentioned with the order blocks, you can blend an old high with an order block here. And you can see, actually, fair value gap, my bad. And you can see how price takes our liquidity pool into a fair value gap. Okay, same thing here. We have a range, trading range. Price can take out a short-term high into a premium market and then have a sell-off. when it comes to internal range liquidities, okay, focus on previous week's highs and previous week's lows, and previous day's highs and previous day's lows. So previous day's highs, previous week's lows. Okay, these ones don't really have as much space and time. If you remember what I just said, this has a big amount of space and time, so that gives a lot of time for liquidity to be building above these highs. But when it comes to previous week's highs and lows, or previous day's highs and lows, you can see the space and time is not as significant. So it's a very short-term hunt. So when a liquidity purge happens, how do we confirm, okay, that's actually a liquidity purge? Okay, and there's two ways. One will be an aggressive approach, and the other will be a conservative approach. Okay, so it depends on what style of trading you like, right? What trader are you? What type of trader are you? Are you an aggressive trader, or are you a conservative trader? Okay, an aggressive trader might have more trades, yes, but the win rate of those trades might be significantly less when compared to someone that's more risk adverse and conservative. So an aggressive confirmation is as soon as price takes out a low, like this, you can start looking for an order block without the break in market structure. Okay, so here we have low to order block. There was no break in market structure here, actually a short-term high, but the point is aggressive is going for the purge straight to an order block, or purge straight to a fair value gap, right? Like this one here, purge straight to the order block. Bearish example is we have a purge here, and then we went straight into a fair value gap here with an order block. Okay, I labeled that one wrong. Here we have a purge above the highs. If we see a gap print, we can take the fair value gap as an entry, and a conservative person would wait for that to break. But an aggressive person, if they see a purge and then a fair value gap, they take that fair value gap right away. So this is a conservative approach. It's where they have the purge, to a market structure break. So they're waiting for highs here, and then they're waiting for that structure to break, or this one as well. Sometimes when it comes to purge to market structure break, you might have to adjust the time frames. So you might have to shift down a time frame for more definition. And again, this is when you have to be flexible. Okay. So here, for instance, was this low right here, but we don't see a high we can consider as a market structure break here. Right, there's no highs here we can consider. So this is when we shift down a time frame into the 4 hour for more definition, and that's what I did here. I shifted down, and then you can see since we went down a time frame, we can see more swing highs and more swing lows. So when price did take out that low, we can see, okay, that's a clean market structure break. And then you'll be waiting for an entire retracement. Okay, so real quick, I'm going to compare the aggressive to conservative here. So conservative, you're waiting for that market structure break, and then you're waiting for that full-on retracement, right? But the aggressive trader doesn't have to wait for that full-on retracement. As soon as the liquidity purge happens here, they can use a order block to enter on, which you can see here. Okay, so They need a clean break above an order block. Why not this one? Well, there was no engulfing green candle here. Okay, so that one didn't work. But in this one, we can see this candle gets engulfed by this bullish candle here. And think of it like as an instant retest. Okay, so there's a rounded retest, and then there's an instant retest for a pop higher. So this one's aggressive, this one's conservative, waiting for the market structure break. Here's an example of a conservative. They're waiting for the low to break, and then the rounded retest. Okay, so low to break, and then the rounded retest. But the aggressive trader would say, okay, that's the purge in liquidity. I'm looking for an engulfing candle to happen, which is a bearish order block. And you can see this is the last up candle here. They could sell into that and not wait for the market structure break. So let's talk about order blocks now. So we just covered liquidity pools, and there's a reason I discussed liquidity pools first. Okay, the very reason I did is that liquidity pools often follow market reversals. Market reversals are highs and lows the market does not want to revisit, therefore forming a long-term high or low. So if we take a look at this, liquidity pools often form a long-term high or low, and it takes a while for this to get revisited here. Just look at the dates there. Okay, so liquidity pools often form long-term highs and long-term lows. Same thing here. Same thing here. And check how it goes from bullish to bearish. Okay, so bullish to bearish. Bearish to bullish. It's a reversal. Okay, reversing from bullish to bearish, from bearish to bullish. So let's talk a little bit more about long-term highs and lows. Okay, once we know a long-term high or long-term low is in, we can expect institutional order flow on that long-term perspective to hold. This makes choosing order blocks very easy. So here we have the first long-term low in. We have long-term low in. Now we can start saying, okay, this order block's going to hold, this order block's going to hold, this order block's going to hold, and these order blocks are going to hold. Okay, and we'll talk about these order blocks in a bit. Okay, but take a look at institutional order flow. Resistance levels start to break. Order blocks, bearish order blocks start to break. Bearish order blocks start to break. Bearish order blocks start to break. Okay, so now this puts perspective. Once a long-term low is in, we can expect these opposing order blocks to break, and these opposing highs to be hunted. Okay. Let's talk about a little bit more about bullish institutional order flow on the daily chart. Okay, so on the daily chart, once we have that long-term low in here, we start looking for bullish institutional order flow. What bullish institutional order flow is that on the daily chart, every down candle will be used for new buying opportunities. So you can see here, down candle here, down candle here, down candle here, down candle here. Now pay attention to this part. After that down candle forms, we can expect displacement. Displacement on the daily chart leads to multiple days of bullish candles. So we can see 1, 2, 3 bullish candles here, displacement, bullish candles here, displacement here, displacement here. So whenever we have down candles, what precedes that is displacement. displacement. And we can expect this to happen when the long-term low is in. And this is all just institutional order flow on the daily chart. And if we look to the left, resistance levels, they're going to break. They're all going to break since bullish institutional order flow is the key here. Now let's talk a little bit about bullish order block probabilities. Okay, so the closer we get to the draw on liquidity, the less likely an order block is going to hold. Okay, let's explain this. So here you can see that if price comes and tests the order block, they're going to hold. Because if we look to the left here, price is in a discount and we've just taken out a old low and we're extremely in a discount here. Okay, even if we got the range high here to range low here, this would be a discount. But the more we start trading higher and higher and higher to potential resistance level, price starts to be in a premium market. And if we blend key levels or an order block in a premium market, they're not going to be expected to hold. Okay, so if we look here, this is where a high forms. Okay, this order block here, since it's in the premium to the left here, when price comes to test it, it doesn't hold. What about this one? When price comes to test it, does it hold? No, because we're still in the premium. But once we get down to fair market value, which is equilibrium, levels can start to hold again if it's bullish, and that's why you see this fair value gap here hold. Okay, so now we're back in bullish conditions. So what we can do now is, okay, once the market has traded back to a discounted market here, we can resume, the order blocks can resume to hold again. So here we've traded into a discount now. Then if a order block prints, a bullish order block prints, they're going to hold as usual. Okay, now with bullish institutional order flow, what happens afterwards? Down candles produce displacement in price. So now let's talk about bearish institutional order flow. Okay, so on the daily chart, every up candle will be used for new selling opportunities. After that up candle forms, we can expect displacement. Displacement on the daily chart leads to multiple days of bearish candles. Okay, now why is this very key for us day traders? Well, this is key because we're not looking for opportunities to enter on the daily chart, but we're looking for opportunities. So once we have an opportunity where we say multiple days are going to be bearish, that means whenever we go intraday on an intermediate term perspective or a short term perspective, all we have to do is wait for price to trade above that high, and then we're looking for our sell entry, and then we're going to wait for the daily candle close, and we're going to wait for that range expansion for our profits. Okay, but this is the easiest part here once we understand what's going on in the long-term perspective. So if we understand that up candles produce displacement in price, every time displacement is happening, this is our bias. Okay, multiple days of being a bearish seller. But let's not forget, bearish institutional order flow is going to happen when a long-term high is in. Okay, so we have a liquidity pool raid here, creates a long-term high, a reversal, and then the move that comes next is bearish institutional order flow. So every up candle will produce selling opportunities. Up candles here, selling opportunities. Okay. So now let's talk about the bearish order block probabilities. So the more we trade into discounted prices, the less likely bearish order blocks are going to hold, right? Because discounted conditions don't blend well with resistance levels. Resistance levels blend well with premium prices. It's because discount is basically oversold and this is overbought. So just think of this like as an indicator. So the closer we get to a draw on liquidity, the less likely the order block's going to hold. Okay, this is when it takes out a low, that's extremely discounted, remember. So we're going to have to wait for price to trade back into a premium. So price, what's the trading range? Well, here to here, that's one. This is a premium. So you might be wondering, okay, where's the order block? Well, that's an order block there. Okay, and this is a breaker. So breaker is an order block that formed the purge. Okay, so here is an order block breaker inside a premium market. Since we're in a premium market, that would act as resistance. Okay, and then after, okay, we traded back into a premium now. Check out bearish order blocks again. Up candle here, displacement to the downside. Up candle here, displacement to the downside. Okay, so that's how you use bearish order blocks on a daily chart. So, order block confirmation. There's two ways we can use an order block. One would be an aggressive approach, the other would be a conservative approach. Similar to liquidity pools. So this is the conservative approach. Okay? The conservative approach will wait for retracement. And retracements occur at opposing liquidity pools. And if the retracement happens, it would trade back into a deep discount or premium. So let's explain this. So here, we're expecting an order block to form because this is bullish institutional order flow right here with the long-term low here. So we're expecting all down candles to hold as support. The conservative way of trading an order block is waiting for price to take out an opposing liquidity pool because that will offer retracement. And then we're looking for a retracement into the last down candle in a discounted price. Okay, here's another example. Price trades back to fair market value, remember, and order blocks will start to resume again. So what we can do is, as soon as this order block prints, we're waiting for the retracement to happen after an opposing liquidity pool gets taken out. Retracements occur at opposing liquidity pools. Then we could wait for price to trade back into the discounted market here. And then we can take action with the displacement there. Okay. This goes the same. So this is a breaker. Low, high, high, low, low. Breakers' intents are to take out liquidity pools. Okay, so let's not forget about that. You can see this low gets taken out. Opposing liquidity pools will offer deep retracements. And in this case, since we're expecting bearish institutional order flow from this high, where is the deep retracement going to occur into? Well, we have this high to this low. Are we looking for this order block? No. Are we looking for this gap? Yes, we could use this gap. But you might have to take a loss there. Doesn't matter. What's the next level? Breaker. Bam. Now, we can start resuming with bearish order blocks. But since we're focusing on the conservative approach here, we have a order block being printed here. So what we're going to do is wait for a swing low to offer retracement. So opposing liquidity pool here will offer retracement into that order block. So that's the conservative approach. Waiting for a swing low to offer that retracement into the last up candle. So here is the aggressive approach. So the aggressive approach just waits for a close. Okay, so closes occur every 24 hours and they don't require a deep discount. So an example is this. Since we know that this is bullish institutional order flow because of the long-term low here, this one will be conservative, waiting for that deep retracement. But an aggressive approach doesn't have to. The aggressive approach just waits for the candle close for the quick instant retest before the displacement. Okay? Here again. This down candle here gets closed above, instant retest, takes out a high. Okay? This one as well. This up candle here, close below, aggressive entry, displacement. Into where? A fair value gap. Then we know, okay, that's going to send prices bullish again. Conservative here is waiting for price to offer retracement into this order block here. But this one is an aggressive one. You're just waiting for the close. So you can see the close happens. Then it quickly taps into this higher here for displacement. So that's the aggressive approach. Some bearish examples of an aggressive approach. You have the long-term high here. So parent order flow is bearish here. We can look for institutional order flow to be bearish, which is this. Now, bearish institutional order flow, we're going to focus on order blocks and imbalances. So, imbalance there. But since we're focusing only on order blocks here, we can see that these up candles gets closed here. That's your aggressive approach. There's no need to wait for a retracement. Okay, no need for deep retracement. As soon as the candle, for instance here, closes below the order block, you can see how this just quickly taps into this low here, then has a displacement. Same thing here. Up candle gets closed below. Up candle gets closed below here. Quickly retests that level, then displacement. Down candle, close above, quickly test that order block for displacement. So you can see that this approach does not require an opposing liquidity pool for a deep retracement like this. You can see this is a deep retracement. As opposed to this, it's very instant. Here's a clean one. Liquidity pool. Up candle gets closed below. Retest displacement. So now let's talk about fair value gaps. And there's also a reason why I discussed fair value gaps last. Okay? And fair value gaps will be used as a probability enhancer. So what that means is, if you see an order block and a fair value gap, that order block turns into a high probability order block. Now, picture that in with parent order flow and institutional sponsorship. If you see an order block with a fair value gap, that is a key level. So here, long-term high forms. Last big beefy candle here, that's your order block. Pair that with fair value gap, becomes A plus order block. So you can see the fair value gap enhances the order block to make a high probability order block. Okay, and now since we're focusing on bearish institutional order flow here, we're focusing on up candles to create new selling opportunities. So you can see here, up candles forms an order block here. Since this order block has a fair value gap with it, that's a high probability order block. So you can look for sells there. Selling opportunities will occur at these levels. 1, 2, 3, 4. That's 4 days of being a bearish seller. Okay. Price takes out a recent low, offers a retracement into this order block. Look what's inside that order block. We have a fair value gap here. That's a high probability order block. Okay. Same thing here. This is the more aggressive order block. You can see up candle with a volume imbalance. A volume imbalance is essentially a fair value gap, but you can just see it instead. So pair this order block with that gap. There's a high probability order block, and you can see that we did have a nice selling day before taking out this low. Up candle with a fair value gap, high probability order block. This the same. But you could also use fair value gap as a key level itself. Okay, so you don't need to focus on the order blocks. Okay, you can just say I'm only going to focus on the fair value gaps. That's it. You don't have to say, to be consistently profitable, you don't even need to know all about order blocks. Fair value gaps is really enough. If you can identify fair value gaps as key levels, then you could already be profitable. You don't need to understand order blocks in depth. So here, price takes out a high, key long-term high prints. Now we know that bearish institutional order flow is going to take place, so resistance level is going to hold. Here is the first resistance level in the form of a fair value gap. Hits that. Since we know that up candles form new selling days, we have displacement to the downside thanks to institutional sponsorship. So every single one of these days here, you have a bearish bias. Same here. With bearish institutional sponsorship and a bearish key level, once we hit that, your bias becomes bearish now. Okay. Targeting a short-term draw on liquidity. So let's talk about when anticipation becomes confirmation. Now, what I mean by this is you have a key level here and you're anticipating a sell-off here. But when does that actually get confirmed? So let's talk about that.